Today, the concept is talking about high net worth estate planning, and high net worth has different starting points for different people. We generally think of that as the 10 million and up crowd. Uh, it's really people who are likely at some point to have either a federal or a state estate tax problem, and depending on where they live and the tax laws that they're subject to when they pass, that level might come down. For example, in New York, Bryce, where we have 3 offices, the estate tax threshold is just over $7 million now, and it goes up with inflation. In Massachusetts, it's as low as 2 million. Rhode Island, it's about 1.8. We'll talk about all the different thresholds. So just be aware of that when you're talking to your clients. I always say to financial advisors, imagine you had this wonderful investment that produced a guaranteed 20% rate of interest. But that 20% interest was subject to 50 cents on the dollar of income tax and another 50 cents on the dollar of estate tax. So out of that 20% in earnings, your client and their heirs only gets to keep 5 cents. So 75% of what you do potentially is going to be taken away by taxation. And one way that you can differentiate yourselves from other advisors is being keyed into these tax issues and showing results on an after-tax basis, not just on a pre-tax basis. Because you'd be surprised at the differential that a little bit of tax planning can make. Who says a trust only has to last for someone's lifetime? More and more we're seeing interest of clients in what are so-called dynasty trusts that stay in effect long after the person who set them up has passed away. And the goal here again is tax efficiency by keeping the funds that are left to the next generation out of their taxable estate. Now the IRS got really smart about 50 years ago, and they enacted something called the generation skipping transfer tax, which is effectively a double estate tax. So if you skip a generation in a taxable estate gift, in other words, mom and dad skip over their children and go to the grandchildren, the generation skipping transfer tax is triggered once you're over that $15 million threshold that's coming into effect next year. So on every dollar over that 15 million that's left, you pay the estate tax. So there goes 40 cents federally. And you pay the generation skipping transfer tax, which is another 40% on what's left over. So it's 40 cents and then 40% of 60, so 24. So the federal government is taking 64 cents on the dollar. Grandkids are getting 36 cents. However, if you fund a dynasty trust with your client's generation skipping transfer tax allowance, and they each have a $15 million allowance, and this trust grows and it's not subject to that GST tax. So if they want to put something in trust for the next generation, for their grandchildren's college, this is a really powerful way to do that. So right now, a married couple has a $30 million upper limit, and there are ways through valuation discounts that we can put things like fractional shares in privately held businesses or a family limited partnership into these trusts and even put more money in there than the 30 million threshold. As you know, if you have clients that are thinking about moving somewhere, Florida is a popular destination, but if they don't want to leave New England, and I can't tell you the number of times I hear in a day, but I like the 4 seasons. I wouldn't mind being, warm in like February and March and beginning of April, but I like seeing snow. I like having Christmas and Thanksgiving with the family. They don't want to leave New England for a sufficient period of time to allow them to become domiciled in a different state. So here we've set out kind of the most, the biggest taxes that hit people in the Northeast. And if you want data for any other particular state, I can get it for you. This is something that we update from time to time for our clients because it's a bit of a moving target. As you can see, New Hampshire at the top is really by far the most tax advantaged state in the Northeast. Really nice. Some things to be aware of, though, is if clients sell capital assets, there is a business profit tax that can get them 6%. So if they sell like a long-term real estate investment that has a large amount of capital gains, that does hit. It's not truly an income tax or a capital gains tax, so it's not on here, but be aware of that. But if you have a client that's has a high consumption lifestyle, and sales taxes are some of the biggest things they pay. They're the kind of people that buy new cars every 2 or 3 years. They're clients that are buying high ticket items. Maybe they have expensive hobbies. Those people need to pay attention to sales taxes. And if you have clients that are generating high amounts of ordinary income through, professional employment or, otherwise, income taxes can be more of a factor. If your client is retired, obviously that's when estate taxes come into play. And many people, think of certain jurisdictions. A lot of people talk about Pennsylvania as being a low tax place, but they have one of the nastiest inheritance taxes out there, which hits from $0 going forward. So someone of modest means, if they overlook one of these taxes, it can actually be paying more tax by going to what they think is a low tax jurisdiction. Conversely, a very affluent person, just by moving across the border to New Hampshire, could save their estate millions, if not tens of millions of dollars. So always be aware of it. This is kind of current as of right now. A lot of states, New York, New Jersey, and Massachusetts, have these millionaire taxes that are enacted at very high levels of income to make the rich pay their fair share,
Right.
As if paying 95% of all the taxes already wasn't their fair share. But always good to keep in mind. So a variation on this, because we realize that people, you can flip the page now, where we talk about asset location in terms of what jurisdiction is taxing this income. And now we think about a more classic situation where you have a client that has a bunch of money in a qualified account as well as some non-qualified securities. So here, the $10 million is split between a qualified account and a New Hampshire trust, just to keep things simple. And here there's two things that are happening. A typical scenario that you would see with a client is a 60-40 balanced portfolio allocation. Fairly standard fare. I realize there's some people that do 80-20 and some people that do 70-30, but the idea here is if the client has about $6 million in non-qualified assets and $4 million in qualified assets, or something proportionate to those amounts, rather than doing both of those portfolios in the 60-40 allocation, if you put the 40 in the qualified account and the 60 in a New Hampshire non-grantor trust, the delta there is even more significant. Any idea why that might be?
Know the answer because we talked about it ahead of time.
And the short answer is it's very simple. It's because in a qualified account, you're changing capital gains income into ordinary income.
Anyway.
Yeah. So what this does by kind of, you have the same allocation overall in the portfolio, albeit it does become a little bit more aggressive over time as the clients draw down on their qualified accounts. With a very similar allocation, you can get a very different outcome by placing the non-qualified equity funds into a New Hampshire-based trust and keeping the qualified funds that are, that are fixed income, are already generating ordinary income in that qualified account. And there the delta is even larger. You end up with 65 million in the first scenario and 91 in the second. Again, this is kind of building on the previous strategy and putting a little bit of a different twist on it. Now, again, if that 65 million is subject to tax inside of a revocable trust, that's going to be cut in half. Mm-hmm. In this scenario, we're assuming we're going to do the similar trust setup. And what you're doing effectively is what we sometimes in the legal profession call hot assets. The things that appreciate the most are the things that are outside the taxable estate. whereas the things that are appreciating at a lower rate of return, the fixed income assets, are kept inside the taxable estate. And in this, in this scenario, as you all know, it's really impossible to push a qualified account outside of someone's taxable estate anyway. So the goal often, we tell our clients, keep that qualified money tax deferred for as long as possible. And for people in a lower net worth bracket, that's often really good advice. For people who are higher net worth, it might be more advantageous for them to spend that qualified money first, because that money is subject to both income tax as well as estate tax. So it's that horrible scenario that we talked about from the outset, where you've got double taxation hitting an already a tax advantage account. Whereas there, you've got potentially a portfolio that has built up nothing but unrealized long-term capital gains. And if you set it right from the outset, broad market-based portfolios, well diversified, it could be across different indices, different geographic regions. You can manage that portfolio without there being a lot of churn. What happens if someone dies in a high tax state like Massachusetts, Maine, Vermont, Rhode Island, Connecticut, New York, with a simple revocable trust? And many people have these trusts in place. They set them up, and their net worth gradually creeps up over time. They're not spending the increases in their portfolio. The real estate that they own could be business real estate, could be their own homes, could be a vacation home. I've often seen a lot of appreciation in these areas, particularly post-COVID. So a client that starts out at a lower threshold might end up creeping very quickly, particularly in a state like Massachusetts or Rhode Island, into these taxable territories. So we did this model based on an initial contribution to a trust, either a revocable trust or an irrevocable trust. That's structured as a non-grantor trust, and we can talk about how to do that in a minute. And showed $10 million, first of all, because that's kind of our definition for high net worth clients, but also because $10 million is an easy number to divide into. You could easily, if the client has $5 million or even $2.5 million, these same, the delta will be the same but proportionally smaller. So if you go in, you can kind of see getting a 7% rate of return. The end of the year, they've got a balance. We're assuming that on the portfolio, 3% of the income is taxed every year. So that can be interest that's earned, qualified dividends, and maybe some capital gains from slight churn in the portfolio, and really slight. So just 3% of the overall portfolio is realized in income. That's going to be subject to a 30% tax. We have a blended federal and state tax rate, kind of a guesstimate there. Some places like New Hampshire, obviously that's going to be lower because there's no personal income tax. It could be higher if you're living in Manhattan, where the top rate approaches 15%. Year-end net income, so year-end net balance, I should say. This is what they end up with, and then we kind of did it in 5-year steps after the first 5 years. And you can see if they're subject to a New York state estate tax and a federal estate tax on what's left over, they're going to lose about $30,000 in estate taxes. Now, imagine the same client, same period of time, they're 65, they put $10 million in, they live for another 30 years, not unheard of in this day and age, especially if you're talking about a married couple. Same thing happens, but this is going inside of a New Hampshire non-grantor trust. So the New Hampshire non-grantor trust doesn't pay state level income taxes, so that's advantage number one. Advantage number two, the way this is structured is all this growth is outside of their taxable estate. So the growth that occurs, not subject to a state income tax on these small amounts of realized income that are coming in every year, and all of the growth is no longer subject to estate tax. So you can see the delta between the two in those scenarios is over $30 million. And that's where the beauty and the leverage of these types of trust structures come in. Setting up a non-grantor trust, probably if you're funding it with marketable securities, you're looking at about $5,000 to set up the trust and maybe another $2,000 to do a gift tax return, maybe less. And then after that, you're probably looking at about $7,500 a year paying an independent fiduciary, which could be our law firm. You guys can still maintain the management of the investments. We would just charge a flat fee for keeping records and filing tax returns. And there's not going to be a lot of administrative costs going over the years. And those administrative costs are largely deductible as well. So you can see whether if the person even had $2.5 million instead of having a $30 million delta, it would be more like a $7.5 million delta, but still significant for a person that's starting out with a relatively small amount of money. So if you have any clients that, and we see this all the time, people have been diligent savers, they've kind of done the right thing, they've fully funded their 401k, maybe they've sold a business, maybe they've had a liquidity event at the company they work for, and all of a sudden they have this pool of cash. You really need to be thinking not just about how am I going to invest this, but where am I going to invest this? And putting it in this type of trust can lead to a huge differential in the client's overall estate size come the end of that period of time.